Let's get across the market open now. Jimmy Jang joining us from Macro. Jimmy, welcome back. Good to speak to you. Well, we've got a raft of earnings out already on this Thursday morning. Let's just touch on some of them we've seen already. Telstra, being one of those.
Morning, Andrew. Yes, definitely. Telstra posted a really good result, 7.1% increase in the half-year net profit to about $1.1 billion. That's leading to about 5.6% dividend hike, which is around 9.5 cents per share. They also announced a $750 million share buyback, which was very interesting. And also their first half earnings rise about 5.8% as well. So especially in this kind of volatile market, which I'll touch on a lot more later down the track, but Telstra is probably one of the best stocks to probably hold right now. It's very cyclical, and one of the probably famous stocks that a lot of the Australian holders will be not volatile compared to what's happening in the US. So that's a really good one to continuously hold if you do, and probably want to slowly allocate if we have a chance. The next one we also looked at this morning was Transurban. They recorded a $15 million statutory net loss in the first half of the financial year. Their first half net loss was roughly about $47 million, and their revenue was only about $1.83 billion. So Transurban is probably another one to kind of monitor really closely today for the viewers, because Transurban definitely is a really good one to add down the track, because obviously with the rate cuts happening, Transurban is definitely one of the stocks that really perform well with the lower interest rate era. So Transurban is definitely another watch list that we wanted to kind of monitor today. And to finish off, we've got Wesfarmers that reported a 2.9% rise in net profit, $1.47 billion for the half year ending to December 31st. Their first half EBITDA was up about 4.7%, and their first half revenue was also up by 3.6% as well. The group also noted that Bunnings Officeworks had the sales growth broadly in line with the first half, but they also did raise a concern potentially with the households in Australia struggling to meet their needs. So they're going to see how that spending power is going to flow down through the market. So those are probably good three stocks to hold on to, Andrew, this morning.
Now, Jimmy, from a macro perspective, of course, we had the rate cut, the first in the cycle from the RBA on Tuesday. Also has had those wage growth figures yesterday. How's that influencing what you're seeing ahead, particularly as far as earnings are concerned?
Really good point, Andrew. The slow wage growth kind of suggests that the inflationary pressures are definitely easing, which is good news for the RBA. It obviously supports their recent decision to cut the rate by 25 bits for the first time in 4 years. So the lower wages means there's less pressure for businesses to raise prices. Obviously, it's reinforcing that broader disinflationary trend that we're seeing with CPI falling to 2.4%. But there's definitely a lot more potential now with the RBA cutting the rate, but they will definitely trade this very carefully, because while the headline inflation is still within their 2 to 3% target, the underlying inflation is still at 3.2%. So if wages stay moderate and obviously the economic conditions kind of soften, another cut later this year is definitely possible. They will kind of have to wait to see how this rate cut will play out. So probably not something that we want to focus on too much, because right now there's a lot more bigger things that's going on around the globe. But something to really keep an eye on is that the RBA may potentially cut another rate cut later this year.
Well, of course, those big things going on around the globe at the moment. Talk of tariffs and threats, further threats from Donald Trump, and concern, of course, being how potentially inflationary those tariffs would be.
It's a wild card how that will impact Australia. If we say a full-blown trade war escalates, like we saw yesterday, Trump government announced this potential 25% tariff on autos and pharma and semiconductors imports to the US. It could really hit global growth and obviously reduce demand for Australian exports, particularly to China for Australian miners. But that said, Trump has signaled that Australia could be exempt from the key tariffs, which could give us some breathing room. But overall, the global trade tension could add volatility to the markets. And as you said, Andrew, tariffs typically raise costs for businesses and consumers. Now, if that happens, the central banks may even delay rate cuts or even reconsider the policy direction. So for now, our view is that markets in Australia and also even in the US are kind of in a wait and see mode on how these trade policies are developing. And we could potentially find some opportunities if we see a bit of a headwind like we saw in the semiconductor industry after the DeepSeek AI was announced in China.
Now, Jimmy, which sectors are you actually watching and perhaps seeing some potential? I guess particularly also in wake of that first rate cut.
Yeah, look, given this kind of a backdrop, retailers offering the small discretionary items like fashion and dining could see a bit of a boost as rate cuts improve the consumer sentiment. Now, that could be a very short-term reaction, but the big ticket items such as cars and furnitures definitely will probably take longer to rebound. So, they are probably one of some of the items that you could look at in your watch list. Something that may not recommend putting it straight away, but definitely where we have a pretty good conviction is the property. Now, we've seen the Sydney building approvals drop to the lowest level since 2011. Now, that kind of supply shortage could put upward pressure on the housing prices. Now, especially with the rate cuts making the borrowing more affordable, investors with this kind of strengthened case for REITs and residential property focused stocks is probably a really good one to add to their portfolio, especially like guys like Real Estate Group and even Goodman Group. Goodman has just announced that 49% of their portfolio is in the data centers for AI. So these are probably good names to potentially add to the portfolio.
And Jimmy, a little more stock specific, and well, just bearing in mind what we're seeing with the banks at the moment. Of course, we had a big sell off yesterday. In fact, that's off the back of results from Westpac and also NAB. Which particular institution are you looking at the moment?
Yeah, look, the banks are very, very overvalued in our view, and I've been kind of saying that for a while in all space. And especially with the banks, it's very difficult for them to have a faster growth because they're all fighting for the same business, which is the mortgage. So the one stock that we actually prefer in the financial sector or financial services is the Macquarie Group. Now, Macquarie Group is an investment bank, unlike the other traditional Big Four banks, and the global M&A activity is expected to double, especially the global central banks are going to push forward with the rate cuts, as we've seen in Australia. And Macquarie's strong presence in the investment banking and asset management puts them in a really prime spot. So some of the key brokers expects the 8.5% EPS growth this year, and 23% in the financial year 26, which is a solid support from the weaker Aussie dollar as well. But in saying that, there are certain risks that this investor should definitely consider, such as the commodity revenue fluctuations could be a headwind because of their exposure in the commodity. But overall, Macquarie's diversified model and the strategic asset sales in that renewables provide some resilience for us and give us the comfort to get into Macquarie right now.